that due to the COVID-19 pandemic, today's meeting is open to the public through a live webcast only. The public may access the meeting by visiting the agency's homepage at www.ncua.gov and clicking on the provided webcast link. Additionally, presenters in today's webcast meeting are participating remotely, so if we experience any technical difficulties, I ask for everyone's patience. As we begin today's proceedings, I note that our open board meeting looks a little bit different today. We have transitioned to a new platform where the audience will not only see and hear the NCUA board members, but also see and hear the presenters on camera instead of just hearing them on the phone. I think this change will improve the quality of our interactions, and I know that all of the board offices were eager to make this change. I also want to thank everyone with the board secretary's office, as well as the office of the chief information officer, for their due diligence in moving to this new platform. Lastly, if you would like to view the live closed captioning of this meeting, please click on the panel labeled Multimedia Viewer found in the bottom right corner of your screen. You may also change the layout to one of your choosing by clicking on the Layout option on the top right side of your screen. Our recommended viewing option for this meeting is the Stack option. Now, turning to our agenda, the first item of business today is a board briefing on the Share Insurance Fund quarterly report. Staff presenting is Eugene Sheed, Chief Financial Officer. Staff available for questions includes Rick Mayfield, Senior Capital Markets Specialist, Office of Examination and Insurance. Eugene, good morning. You may begin when you are ready.
Good morning, Chairman Harper, Vice Chairman Hauptman, and Board Member Hood. This is Eugene Sheed, and I'm here to present the fourth quarter statistics for the Share Insurance Fund. Before I begin my quarterly update, I will note that our external auditor, KPMG, under a contract monitored by the NCUA's Office of the Inspector General, has completed the financial statement audit for the Share Insurance Fund for the year ended December 31st, 2021. The fund received an unmodified or clean opinion on the presentation of its financial statements with no reportable conditions. This is also true for the audits of the operating fund, the Community Development Revolving Loan Fund, and the Central Liquidity Facility. In the audit report, KPMG concluded the financial statements were fairly presented in accordance with U.S. generally accepted accounting principles. There were no material weaknesses or significant deficiencies in internal controls that would cause the financial statements to be materially misstated, and there were no instances of non-compliance or other matters that are required to be reported under government auditing standards. Slide 2. The year-end financial statements are posted on NCUA's website as of February 15th. In addition to my team, staff throughout the agency worked on the year-end financial statements and the reporting and auditing processes, and I want to thank everyone for their contributions. Slide 3. Slide 3, this table shows the Share Insurance Fund's revenues and expenses for the fourth quarter of 2021. For the quarter ended December 31st, 2021, the fund recorded net income of $12.6 million. Total income of $62 million primarily consists of investment income from Treasury securities at $61.9 million. Operating expenses were $52.3 million for the quarter. The provision for insurance loss reserve expenses increased by $3.2 million during the quarter. I will discuss that further on slide 5. The AME loss reduction for natural person credit unions and corporate credit unions decreased by $1.5 million and $4.6 million respectively due to favorable changes in the estimated future cash flows of assets held by certain asset management estates. Slide 4. Slide 4, this table shows the Share Insurance Fund's balance sheet as of December 31st, 2021, compared to the previous year. As of December 31, total assets are valued at $20.7 billion, of which 98% are funds held within U.S. Treasury in cash, overnight investments, and long-term Treasury notes. Overall, total assets increased $1.6 billion, largely due to the $2 billion in capital deposit adjustments for credit unions during the year. The net receivable from the asset management estates is $223 million. The receivable from the natural person credit union asset management estates decreased $4.7 million from last year due to decreases in future cash that we expect to collect. The receivable from the corporate credit union asset management estates decreased by $534.1 million, primarily due to cash collections, partially offset by an increase in future cash that we expect to collect. Accrued interest and other assets are $111.3 million, which increased 30% from last year end, largely due to an increase in the Treasury interest receivable. Total liabilities are $171.4 million, or 1% of total assets. Accounts payable and other liabilities of $9.4 million primarily consists of pending distributions to credit unions and payables due to the operating fund. The fund's net position comprises of cumulative results of operation and capital deposits, which represents the total balance of all federally insured credit unions' 1% capitalization deposits. Cumulative results of operations decreased by $351.9 million during the year due to a decrease of unrealized gains on investments of $536.4 million, offset by $184.5 million in net income for the year. Net capital deposit activity increased by $2 billion this year. Slide 6. The SIF records an insurance program liability, which is comprised of general and specific reserves to cover losses resulting from insured credit union failures. Each quarter, the SIF assesses the reserve needs for credit union failures to make reasonable estimates of losses. During the fourth quarter, the reserve expense increased by $3.2 million, primarily due to an increase in the general reserve. At the end of the year, reserves totaled $162 million and consisted of $6.6 million for specific reserves and $155.4 million in general reserves. Next slide. Through the fourth quarter of 2021, 7 credit unions failures incurred a loss to the fund. There were 3 involuntary liquidations with purchase and assumption agreements, 1 involuntary liquidation without a purchase and assumption agreement, and 3 assisted mergers. The cost of the failures for 2021 was $5.6 million at the time of loss. Fraud was a contributing factor in 4 of the 7 failures. Slide 7. As of December 31st, 2021, the Share Insurance Fund had $19.6 billion at par value invested in Treasury securities, with maturities out to November 2028. The weighted average life of securities held by the fund is 3.5 years. The weighted average yield of securities held by the fund decreased 2 basis points from the last quarter to 1.21%. The lower bar chart shows the cumulative picture of how much of the portfolio will mature over time. About 71% of the portfolio will mature over the next 5 years. During the fourth quarter of 2021, 5 Treasury notes matured in the amount of $500 million. These securities had yields ranging from 1.47% to 1.92%. As a reference for interested stakeholders, the current NCUA investment policy is included with my presentation materials today, and we will be posting it on the NCUA website. Slide 8. Turning to the equity ratio chart, the current equity ratio was calculated as of December 31, 2021. Per policy, the equity ratio is updated semi-annually. The current equity ratio is 1.26%, an increase of 3 basis points from June 2021, and was calculated using an insured share base of $1.63 trillion. The blue line running across the chart represents the normal operating level, which is currently 1.33%, a decrease of 5 basis points from the previous normal operating level of 1.38%. Slide 9. The fourth quarter Camel data presented on the following 3 slides is current as of December 31st, 2021. This slide shows the distribution of insured shares by Camel codes from 2016 through the fourth quarter of 2021. In the area graph at the upper portion of the slide, the red portion of the graph is the percentage of total credit union assets that are Camel coded 4 or 5. The green represents the percentage of Camel coded 3 credit union assets, and blue represents the percentage of credit union assets that are Camel coded 1 and 2. The chart underneath the area graph displays the total number of credit unions by their respective Camel codes. During the quarter, the share for credit unions with Camel code 1 or 2 increased slightly to its highest percentage since December 2016. The Camel percentage for credit unions Camel code 3 and those for 4 and 5 decreased during the quarter. As depicted in the bottom chart, the number of credit unions as of December 31st, 2021 was 4,953. This is a decrease of 50 from the prior quarter. Slide 10. This slide compares credit unions' Camel codes by asset size. Camel 4 and 5 credit unions are shown on the left-hand side, whereas Camel code 3 credit unions are displayed on the right-hand side of the graph. Looking at the 129 total credit unions that are Camel code 4 and 5 by asset size, most of the credit unions continue to have assets of $100 million or less. During the quarter, there was a small increase in the number of Camel coded 4 and 5 credit unions with assets from $100 million to $500 million, and no change in those with assets greater than $500 million. During the quarter, insured shares and assets for credit unions Camel code 4 and 5 remain the same at $8.1 billion and $8.8 billion, respectively. Turning to the 752 credit unions Camel coded 3, most of these credit unions continued to have assets that are less than $500 million. During the quarter, there was a decrease in the number of Camel coded 3 credit unions with assets ranging from $500 million to $1 billion, and no change in those with assets greater than $1 billion. During the quarter, for credit unions coded Camel 3, insured shares decreased from $42.1 billion to $38.1 billion, and assets decreased from $47.4 billion to $43 billion. Slide 11. This slide shows the distribution of Camel code, distribution of assets by Camel code from December 2006 to December 2021. As in slide 9, the red portion of the chart is the percentage of credit union assets that are Camel coded 4 and 5. Green represents the percentage that is Camel coded 3, and the blue represents the percentage that is Camel coded 1 or 2. The distribution of assets over the last quarter for Camel 1 and 2 increased from 97.2 to 97.5%. The distribution of assets for Camel 3 credit unions decreased from 2.4% to 2.1% during the quarter. And finally, the distribution of assets for Camel code 4 and 5 credit unions remained the same at 0.4%. Next slide. This concludes my presentation. Joining me for questions and answers is Rick Mayfield, Senior Capital Market Specialist in the Office of Examination and Insurance and an advisor to the NCUA's Investment Committee. We will be happy to answer your questions. Thank you.
Thank you, Eugene, for that quarterly update on the National Credit Union Share Insurance Fund and its performance during 2021. And thank you, Rick, for being available for questions. Before I begin, I would like to thank everyone on the team of the Office of the Chief Financial Officer for their contributions in ensuring that the NCUA's 4 funds earned another unmodified or clean audit opinion in 2021. I also want to thank the Office of the Inspector General and our independent auditor, KPMG, for their excellent work and assistance throughout this process. For nearly 40 years now, the NCUA has earned an unmodified opinion for the audits of each of its funds. This sustained achievement underscores the NCUA's commitment to transparency, accountability, sound financial management, and the careful stewardship of the resources entrusted to the agency. As a regulator, we need to hold ourselves to the same financial reporting standard that we expect of all credit unions we oversee. So thank you again to everyone for a job well done. After another challenging year, the Share Insurance Fund continues to perform well and remains on a solid footing. Overall, the credit union system has also, thus far, withstood the pandemic's evolving economic fallout. This is a testament to the strength of the credit union system going into the pandemic and the skillful management of credit union CEOs, boards of directors, and staff over the last 2 years. Nonetheless, the credit union system and the Share Insurance Fund continued to experience elevated insured share growth in 2021. To illustrate this point, the insured capital deposit for the Share Insurance Fund was $12 billion at the end of 2019. 2 years later, the insured capital deposit increased to $15.8 billion at the end of 2021, a nearly 32% increase since the pandemic began. If the elevated growth of insured shares continues, we can expect a further erosion of the Share Insurance Fund's equity ratio, so we must remain watchful. What is more, the emergence of inflation, something many Americans have never experienced at this rate before, means that the interest rate environment remains uncertain. To slow inflation, the Federal Open Market Committee is expected to increase interest rates starting in March. How often and how much interest rates increase have yet to be determined. Nevertheless, the NCUA and credit unions must be ready to adjust to these changes. Additionally, the NCUA must continue to monitor credit union performance because, in my view, the system has not yet experienced the full extent of the pandemic's financial and economic fallout. With this added level of uncertainty, the NCUA board will need to continue to analyze the Share Insurance Fund's risk exposure and remain prepared to act, consistent with our statutory and regulatory responsibilities. Before concluding, I do have 3 questions. First, let's turn to slide 3. There, we see that the Share Insurance Fund's net income for 2021 was approximately $150 million higher than it was at the year end of 2020. What were the key contributors to this significant and positive change to the fund? Eugene?
This is Eugene, and I'll address that question. The most significant contributor to the increase in the net income in 2021, and a key change as compared to 2020, is the reduction in loss expense that you see on the slide. The primary driver of the recent net recoveries has been the corporate AME performance. The corporate AME's net recovery improved during the year based upon the receipts from the U.S. Central Capital Distribution, security valuation improvements, and gains on security sales. As the NGN Overnight Committee continues to orderly liquidate the remaining securities in the portfolio, we'd expect to see some continued improvement in valuation, although the security sales will wane. That concludes my response.
You might be on mute, buddy.
Thank you. We can change technologies, but we still have the problems with the mute button. Let's turn to slide 5. I see that the net position of capital deposits grew by nearly $2 billion in 2021. That's on top of elevated growth in insured shares in 2020, which I mentioned earlier. Is this the fastest 2-year growth rate that we have experienced in the total amount of insured shares since the creation of the Share Insurance Fund? I ask because later today, we will consider whether to extend the temporary modifications to prompt corrective action that we adopted in response to the considerable increase in insured shares at the start of the pandemic. Does this trend in insured shares show any sign of abating?
This is Eugene, and I'll address those questions as well. As I understand it, the capital deposit growth that you've referred to, that over the past 2 years, is the largest, and as the statistics you quoted a moment ago, an increase of $3.8 billion from the start of 2020 to the end of 2021, an increase of over 30%, which I understand to be the largest, certainly since the mid-'80s, if not since the inception of the fund. I understand in consulting with the chief economist that they're anticipating growth for 2022 in insured shares, but at the rate closer to the historic or the historic average, and not the historic rate that we've been seeing in the past 2 years. That concludes my response.
That's helpful information, Eugene. My last question is about interest rates. When the Federal Open Market Committee meets on March 15th and 16th, the Federal Reserve has already signaled an increase in interest rates. What are the potential effects of these rates, and what will they do to the equity ratio and the share insurance fund going forward?
This is Eugene, and I'll take that question as well. I'd say all else being equal, I'd expect a rise in the rates to have a positive impact on the fund and on the equity ratio. For a matter of fact, we've already seen the Treasury market pricing future rate hikes. But the interest rates are only one factor of many that impact the fund, as you know. The average yield on our portfolio should start to increase if longer term interest rates stay where they start to increase. Higher rates would mean an increase in revenue for the fund. The SIF financials would temporarily show an unrealized loss with the rising rates, just as they showed an unrealized gain when rates fell. But unless there's an acute liquidity need, we hold our investments to maturity and would then be reinvesting in the future at more favorable rates. Absent an upturn in losses to the SIF from credit union failures, the equity ratio should improve in a scenario relative to the lower rate environment. That concludes my response.
Eugene, that's a very thoughtful and thorough answer. Thank you. That concludes my remarks. I now recognize Vice Chairman Hauptman.
Thank you, sir. And by the way, Chairman, I feel your pain on being accidentally on mute. And I'll at least mention that the bigger risk in this life is thinking you're on mute when you're not. So, and thanks to Eugene and staff for that report. A lot of good news there. The credit union movement continues to perform well, despite the challenges of the pandemic. The percentage of assets held in Camel 1 and Camel 2 credit unions continues to rise and is now at a record level of 97.5%. Losses to the share insurance fund were at extremely low levels these past 2 years. And despite the larger than expected growth in insured shares during the second half of last year, federally insured credit unions have maintained an average net worth in excess of 10.2%. And even without the extra $135 million in cash from the wind down of the corporate asset management estates, net income was still strong and expected to grow. Of course, this leads me to the issue of NCUA's investment strategy. The portfolio, as shown on slide 7, was just under $20 billion at the end of last year, the largest it's ever been. Although I'm grateful we finally made our investment policy public, it's a good time to reevaluate the strategy. The fund is a mutual asset. It's reported and controlled by NCUA and an asset reported by the credit unions. Credit unions are required to supply the majority of the fund's equity through a 1% contribution of their insured shares. Just like any credit union board, the NCUA board has the responsibility to regularly review its investment strategy. And for the sake of transparency and clarity, to do so at an open board meeting. So a few questions focused on slide 7, the investment portfolio. Number one is, how does NCUA's approach to investments differ from credit unions? Meaning, do we instruct credit unions to do one thing and then we do something different for ourselves? Can we talk about that?
Yes, Vice Chairman Hauptman, this is Rick Mayfield, and I'll be answering that question. NCUA's credit union supervision of interest rate risk is a comprehensive.
Speak up a bit, Rick. Can you speak up a little bit?
Yes, I'll try. So NCUA's credit union supervision of interest rate risk is a comprehensive look at both the credit union's on-balance sheet and off-balance sheet exposure relative to capital positions. Credit union operations are dynamic as depositories in responding to member needs, operational liquidity, and strategic planning. The SIF's investment committee uses the principled SLY approach, which is safety, liquidity, and yield, to investing in the SIF's funds with a purpose of providing deposit insurance to the industry. While the results of a credit union's IRR approach and the SIF investment strategy may look different, they're both principled on strategic goals. Both situations will have an investment policies, portfolio monitoring, and risk management. So in summary, whether a financial institution or an insurer with a portfolio of U.S. Treasuries, the underlying government's framework must be safe and sound. This concludes my answer.
Appreciate that. And Eugene, let me say this, that jobs like running NCUA's fund always come with critics. What would you say to critics who believe that some of our recent investments were ill-timed and resulted in the NCUA leaving money on the table, so to speak?
Actually, I'm going to ask Rick to address that question, please.
Gladly. So I would say the share insurance fund investment strategy intentionally does not try to time the market.
Yep.
The strategy uses a disciplined approach, investing in a 7-year ladder. This keeps the share insurance fund's weighted average maturity just under 3.5 years, or maybe slightly lower if we increase our liquidity. Share insurance fund investments are market yields. As such, available information should be priced into the market. We are price takers, not price makers. So taking us back a bit in my time in the NCUA, I remember when the share insurance fund's portfolio investment policy and strategy were changed in late 2007 to invest in longer-term Treasury securities and use a ladder strategy. Some in the industry questioned why this was being done, since they believed rates were likely to go up. The investment committee pushed for these changes since they were the right thing to do. The share insurance fund needed to take human nature out of the decisions and have a strategy that produced a higher expected return while maintaining safety and liquidity in the fund. And to be honest, I also thought rates were going up at the time. We held our noses, we did the right thing, and it paid huge dividends for the industry. On the other thing I would like to note is, had the investment committee waited to invest the share insurance fund assets, they would have earned less than 10 basis points if they waited. The resulting reduced earnings is also a form of leaving money on the table. And then there's the question on what would be the proper time to invest these funds. My fear waiting for the proper time would lead to paralysis and cost the share insurance fund in the long run. And lastly, what if rates would have gone down? This concludes my answer.
Appreciate that. And I definitely agree on market timing. I think for most investors, more money is lost trying to time the market than is gained. And last one here, the current investment policy approved by the board in 2013. What changes should we consider to that policy?
This is Eugene, and I will take that question. So I think the areas to review and consider in looking at the existing policy would be first to discuss the latter approach that Rick was just referring to. I think the approach serves us well, but there are options that could be discussed and considered, such as the duration of the ladder. The other area I would suggest for discussion is the reporting and transparency that are expected, and whether those should continue as they are or whether they should be changed. The policy gives the direction to the investment committee and the CFO on reporting, such as what I report at this SIF quarterly presentation and in the monthly financials. But we should consider whether that's still relevant and sufficient, or whether the board or stakeholders would like us to present something different in terms of reporting and transparency. That concludes my response.
Thank you. I look forward to working with my fellow board members on reviewing and updating the investment policy. Mr. Chairman, that concludes my remarks.
Absolutely, you've got my commitment. I think it is an appropriate time for us to look at the investment policy and how to adjust it. Board Member Hood, the floor is yours.
Great. Thank you, Mr. Chairman. Eugene, thank you for your presentation this morning. But before I continue, I want to thank you and recognize you and your team for 4 very successful audits. Thank you for your hard work to all of you and your team members. Going back to today's presentation, it's clear that last year was a great year for credit unions. Therefore, was also a great year for the National Credit Union Share Insurance Fund. In 2021, there was net income largely due to recoveries and no significant losses to the fund. Eugene, in your presentation, you mentioned that we made the NCUA's National Credit Union Share Insurance Fund investment policy public. This is the credit union's fund since their assets are the ones that comprise the fund that the board oversees. So I'm glad and delighted that this is now a public document. It certainly fosters greater transparency. My first question this morning, though, has to do with slide 4. If we could please turn there, and our net position. The net position of the cumulative results of operation decreased during the year. Eugene, can you please address that and what impact this had on our equity ratio?
Yes, I will take that question. Thank you for the question, Board Member Hood. And we've got slide 4 up on the view, and you can see the cumulative results of operation did decrease during the year. This was due to the elimination of an unrealized gain in our investment portfolio. When interest rates dropped in 2020 at the onset of the pandemic, the fund recorded significant unrealized gains in its portfolio. Interest rates have started to go up, and that gain has now been eliminated. This does not impact the equity ratio calculation because that calculation excludes unrealized gains. That concludes my response to the question.
Great, thank you, Eugene. As I look back at 2021 and looking forward to 2022, while the pandemic remains a challenge, it has in fact moderated, and we've gotten much better at coping with that reality. The January employment report with a surge of 467,000 added jobs and evidence of wage gains was certainly welcome news to all of us. While at the same time, we've also seen several signs that remind us that the economy is not yet back to pre-pandemic levels, and there are other looming challenges that are indeed a matter of concern. To take the most obvious example, they're still getting around the reality of rising prices, with inflation at 7.5% in January, the highest we've seen in nearly 4 decades. That poses a real concern around interest rate risk, which we've already discussed. I'm also concerned about the growing national debt and how this will eventually impact the overall economy. It's not my intention to dwell on the negative. In fact, I do remain optimistic that things will continue to improve. But we do need to look reality squarely in the face to recognize that the conditions are still challenging and will likely continue to be so for the immediate future. We need to be planning accordingly for an environment that's marked by tremendous uncertainty. I would now like to Eugene to address the true-up and its impact on our equity ratio. At a recent board meeting, the chairman referenced a report done by an outside accounting firm regarding the true-up. While it's easy to let the true-up issue sweep us all away in technicalities, it is a very critical issue. In fact, it is perhaps one of the most important issues for credit unions whose assets comprise the fund. Let me explain. In simple terms, the equity ratio has a numerator and a denominator. The denominator is insured shares, and the numerator is contributed capital and retained earnings. There is, in fact, a timing difference that is important to discuss in calculating the equity ratio at year end. While insured shares are as of December 31st, NCUA is not yet billed for the new capital deposit balances from the December 31st insured shares, and thus we use June 30th data at year end for this piece of the equation. This, in fact, causes a timing issue. The true-up is relevant because today we report the equity ratio at 1.26% at year end. However, if the equity ratio calculation did not have the timing difference, such that both components were derived from the December 31st data, and then the equity ratio would be approximately 1.29%. The credit unions that own the fund are directly impacted by the assessments of premium charges and distributions. And in my view, the practice could lead the public to misunderstand the true strength of the fund. Eugene, since 1999, how many basis points has the subsequent true-up been?
Thank you for that question, Board Member Hood. Since the current process was established, the average subsequent true-up that the NCUA does in March has been about 2 basis points on average, with the overall range being slightly less than 1 basis point up to 6 basis points. That concludes my response.
Well, thank you, Eugene. And then what was the high watermark then in basis points?
Thank you again for the question. The high water mark was 6 basis points, and that was reached in March of 2021 billing cycle for the December 2020 insured shares. The impact of the true-up is greater when there's a significant growth in insured shares. In 2020 saw a large increase in insured shares due to the pandemic. That concludes my response to the question.
Great, thank you, Eugene. Credit unions follow accounting standards codified by the Financial Accounting Standards Board, which are applicable to commercial entities, while the NCUA follows standards promulgated by the Federal Accounting Standards Advisory Board for our National Credit Union Share Insurance Fund. The NCUA changed its accounting standard for the NCUSIF in 2010 from the commercial standard to the government standard. Eugene, this change did not cause the true-up issue, is that correct?
You are correct, sir, that the change from the commercial to the federal GAAP that you referenced did not cause the timing difference or the true-up. And as you note, that change occurred in 2010, and the timing difference pre-existed under the commercial GAAP approach used prior to 2010. And that's because the basic principles for revenue recognition are the same. In fact, here's a quote from the NCUA's 2001 annual report that reflects that the issue existed under the formal the time period when the commercial GAAP approach was used. And this is the quote. The calculation of the ratio is based on insured share deposits from credit union call report data for the final reporting period of the year. In 2001, credit unions had recorded a 13.8% increase in insured share growth. However, in accordance with accounting principles generally accepted in the United States of America, the deposit adjustment credit unions submit to the Share Insurance Fund to maintain their required level of 1% of insured shares is not recorded until March of 2002. And that's the end of the quote, and that concludes my response.
Great, thank you for that, Eugene. So then, as I understand it, the true-up issue came about in 2000 and did not exist before then. So one, can you explain why that is? And then to follow up with that, is it possible at all to improve our data collection procedures to improve the reporting under current accounting standards?
This is Eugene again. And as I understand it, the current practice came about in 2000 because of the Credit Union Membership Access Act of 1998, which then had an implementation period the next couple of years subsequent. At the board meeting in January of 2002, then board chairman Dennis Dollar asked the CFO at the time if the change that had occurred was the result of that act. The CFO replied this way, quote, "That's right. Under the old Federal Credit Union Act, we would base these calculations on the prior year's insured shares. So we would be looking at the December 2000 insured shares. That act changed how we approach this. We have to recalculate now every 6 months based on insured shares that we have as of June 30th and December 31st. They require us to use the most current share information. There was always a true up, but it was backwards looking prior to the change and done only once a year." And that's the end of that part of the discussion from the board meeting. So that's a very different approach than what we have today, that which was used prior to the change in the statute. And so where we are using the most current information now as of December 31st, the old process used the prior December 31st as a part of the calculation in the billing. That concludes my response.
Great, thank you, Eugene. That's really helpful. Now, turning back to the memo I referenced earlier, the memo that was produced by the outside accounting firm states that the timeliness and accuracy of the data is required in the Federal Credit Union Act. So this provision in the law, and I quote, "may provide some latitude from a strict interpretation that the equity ratio must be calculated based on the financial statements amounts, particularly given the knowledge of the timing effect on the calculation of the equity ratio. Accordingly, it may be permissible to use the pro forma calculation of the contributed capital amount when calculating the actual equity ratio," and I end the quote. What are we doing to implement the outside accounting firm's recommendations or any other of the recommendations to find a solution to the equity ratio reporting concerns I've outlined this morning?
So this is Eugene, and I'll take that question as well. Our original engagement with that accounting firm took a look at whether or not using the existing processes that we have today and the applicable accounting standards and the current laws and regulations, whether there would be some way for us to adjust the timing recognition of the revenue. And not having found that being possible, we are now moving to understand what business processes and policies would need to change, how they'd conform or not conform to existing laws and regulations in order to reduce or eliminate the underlying issue that you've been talking about, which is really the timing gap and the best presentation of the equity ratio. We are assessing the recommendations that you reference, engaging with our colleagues in the General Counsel's office, and then reaching out to other impacted NCUA offices as well. One of the approaches that you mentioned is the idea of the pro forma equity ratio calculation. And I think that's an intriguing one and one that we're certainly going to explore to see if there is a way to, again, close that timing gap and provide what might be considered a stronger equity ratio representation. So I look forward to keeping the board apprised of as we additionally look into these options. I know that you've got a keen interest in it. And again, I think we all share in wanting to make the equity ratio stated in a way that is timely and as meaningful as it can be. That concludes my response to the question.
Great, thank you, Eugene. I just have one final question. I certainly want to thank and applaud you for making our investment strategy public. And in so doing that, I'd like to ask that we could get you to please commit to placing the outside accounting memo on our page as well, so that our public can also understand that as well, all under greater transparency. So would love to, again, see that accounting memo made public, just as you've done for the investment strategy.
Okay.
And thank you. I have no further questions.
Great. Thank you, Board Member Hood. I certainly found your economic analysis at the start of your questions about the uncertainty environment that we've got. It's spot on. And with respect to the choppiness of the true up and how it affects the equity ratio, I really appreciated your insights. And certainly that's something that we should continue to look at and to work on. And thank you, Eugene, Rick, and also Mei Zhu, who has been working behind the scenes for the slideshow today. That concludes our discussion on the quarterly report on the Share Insurance Fund. The second item on our agenda today is a notice of proposed rulemaking, Part 700, 701, 702, 708A, 708B, 750, and 790, asset threshold for determining the appropriate supervisory office. Staff presenting are Scott Hunt, Director of the Office of Examinations and Supervision, and Rachel Ackman, Senior Staff Attorney, Office of General Counsel. And staff available for questions includes Frank Cressman, General Counsel. Scott, Rachel, why don't you start when you are ready?
Good afternoon, Chairman Harper, Vice Chairman Hopman, and Board Member Hood. I'm here to present a proposed rule that will effectively change the board policy defining when a large consumer credit union transfers to the supervision of the Office of National Examinations and Supervision, otherwise known as ONES. In brief, I'm proposing the new threshold be set at $15 billion in assets. This action is consistent with the board's intent as expressed in the 2022 agency budget. The new policy will be accomplished through a series of definitional changes as specified in the proposed rule. The impetus for this change is to balance the resource demands of the ONES supervision program with the potential risk a large credit union poses to the Share Insurance Fund. When ONES was launched in 2014, 4 credit unions had assets of $10 billion or more, and the insurance fund balance was about $12 billion. Today, ONES supervises 11 large consumer credit unions, and the insurance fund stands at $20.7 billion per CFO Sheed's remarks just before now. However, there are potentially 9 more credit unions that would transition to ONES effective January 2023 under the current rules. This substantial growth would require a significant investment in field personnel by ONES. If this proposal is approved by the board, it is projected only one credit union would transition to ones over the next 2 years based on growth trends. Thus, this change will slow the pace of growth of the ones portfolio. I will also highlight what will not change under the proposal. Any credit union currently supervised by ones will remain with ones. Effectively, they will be grandfathered. Ones has 3 credit unions with assets less than $15 billion as of December 2021. All 3 have assets above $14 billion. Therefore, we believe it will be less disruptive to retain these credit unions in ones when it appears likely their assets will exceed $15 billion in the near future. March 31 will remain the measurement date to determine applicability of the threshold, and the following January will be the effective date for transition into ones. We believe retaining these dates best provides for ease of planning any potential transitions, both for credit unions and the agency. The capital planning and stress testing requirements will remain, with the tiering system also maintaining their current thresholds. Ones will work with the regions to transition responsibility for capital plan reviews for Tier 1 credit unions. All credit unions $10 billion or more will submit investment share and loan data to NCUA as is current practice. This requirement enables NCUA to implement and oversee the capital planning and stress testing rule while also enhancing its supervisory efforts. Ones will remain the primary point of contact for the data collection and will continue its current practice to onboard new credit unions to this requirement prior to their transition date. Credit unions are reminded ones posts information pertinent to large credit unions on the agency website under regulatory and compliance resources. This includes links to regulations, guidance, capital planning, summary reviews, and the share and loan data template. We encourage credit unions to reference this information to inform them of supervisory and regulatory expectations. Staff proposes the rule be issued for a 60-day comment period. This concludes my remarks. I'd be glad to answer any questions.
Thank you so much, Scott, for your presentation on the proposed rule to adjust the asset thresholds for certain consumer credit unions when assigning supervision to the Office of National Examinations and Supervisions, otherwise known as ONES. Frank and Rachel, I also appreciate your willingness to answer questions. And many thanks to everyone in ONES and the General Counsel's Office for their efforts in bringing this proposed rule before the NCUA board. This proposed rule results from staff recommendations and the collaboration between all 3 board offices during the development of the NCUA's 2022 and 2023 budget, which we approved in December. This proposed rule is also a natural evolution of the agency's examination program, resulting from industry growth and a reconsideration of risk management. Over the last 2 years, many federally insured credit unions have experienced significant balance sheet growth, resulting from 3 stimulus packages, changes in consumer behavior, and other pandemic-related policy actions. For example, credit unions with just below $10 billion in total assets saw their balance sheets grow by approximately 14% on average in 2020 during the first year of the pandemic, and more than 34% in one case. In contrast, in 2019, these same credit unions saw their assets increase on average by just 9%. Under this proposed rule, the NCUA would recalibrate the asset threshold that would move a consumer credit union from supervision by one of the NCUA's regional offices to ONES. In creating ONES a decade ago, the NCUA board set that asset threshold at $10 billion. The proposal before us today would adjust that threshold to $15 billion. Thus, credit unions with assets between $10 billion and $15 billion would remain with their current regional office. And all large credit unions currently under ONES supervision with less than $15 billion in assets will continue to be supervised by ONES. No other regulatory requirements for credit unions covered under these regulations would be altered. The NCUA board is considering this regulatory change for 2 reasons: resource allocation and risk management. First, the agency can more effectively manage its resources by continuing to supervise most credit unions between $10 billion and $15 billion in assets through the regional offices. Without this adjustment, the number of covered credit unions supervised by ONES, covered consumer credit unions supervised by ones would nearly double in 2023. That would require a substantial reallocation of personnel within the agency. Additionally, this hybrid arrangement in the supervision of the system's largest credit unions provides other benefits to the agency, including sharing knowledge and expertise between ones and regional staff, creating new developmental opportunities for our examiners, and ensuring credit unions that transition to one's supervision are better prepared for the change. So this modified approach truly leverages the best of the agency's regional structure with one's expertise while efficiently using existing resources and stabilizing and maintaining one's workload demands. In the longer term, we should, in my view, consider the development of a regional large credit union program for larger credit unions. Second, the board has reconsidered the level of risk to the National Credit Union Share Insurance Fund posed by a credit union with between $10 billion in assets and $15 billion. Scott, would you explain in more detail how the risk profile of a credit union of $15 billion or more in assets today compares to one with $10 billion or more in 2013?
I'd be glad to. At the inception of ONES, when it was formally created by the board, the principle was that the creation of an office to oversee those institutions that pose a potential systemic risk to the share insurance fund. Not an actual risk, potential. That is, should a credit union fail, it could have a material impact to the health of the share insurance fund. At that time, back in 2012, under the deliberations, the share insurance fund was approximately $12 billion. As alluded to in the remarks earlier, that share insurance fund has now grown to over 20 billion. Looking at our loss history, we believe the $15 billion threshold is now proportionally consistent.
Thank you, Scott. I assume that's the end of your answer.
Yeah,
Thank you very much. Okay. I think that it is important to point on, it is an important point on the evolving risks that larger credit unions potentially pose to the share insurance fund and the broader credit union system. Finally, credit unions with $10 billion or more in assets are subject to capital planning requirements regardless of this change. For those credit unions who will be new to this process, what is the timeline for when they need to comply with those regulations? And how will we train our regional examiners about their new responsibilities related to supervising for capital planning?
Sure, I'd be glad to answer those two questions. So the first question, if this new threshold is approved, credit unions newly entered would have up to December 31st, 2023 to comply. As stipulated in the regulation, March 31 would be the date of compliance. Are you at $10 billion, therefore subject to the Tier 1 capital requirements? And if so, they're required to develop the capital plan the year of the following year, which would be January 1 through December 31. So any date in between, they can develop their plan. As to how we're training the training the regional staff, we already have a training plan developed. We'll be reaching out shortly to kick efforts off to work with our regional counterparts. It will consist of job aids. It will consist of live demonstrations, as well as we have senior specialist staff that will be working with the regions as they conduct their reviews next year. And that concludes my remarks.
Thank you, Scott, for those insights. In closing, this proposed rule is a natural evolution of the agency's examination program. Additionally, this proposed rule leverages the strengths of the agency's regional structure to ensure the NCUA can effectively and efficiently monitor potential risks associated with these institutions within existing resource allocations. It also provides proper oversight for those systemically critical credit unions which pose a significant risk to the share insurance fund because of their size and complexity. That concludes my remarks. Vice Chairman Hauptman, the floor is yours.
Thank you, sir. And thank you, Scott, for your presentation. I'm supportive of this NPR for several reasons. First, the relative risk to the share insurance fund today for a $15 billion federally insured credit union represents the same relative risk as a $10 billion credit union did back in 2013, when Tier 1 credit unions first transition to one supervision. Second, this adjustment will allow NCUA to more efficiently manage its resources by continuing to supervise most Tier 1 covered credit union through the regional offices. Without this adjustment, the number of covered credit unions supervised by ones would nearly double in calendar year 2023, requiring substantial reallocation of agency resources. That reallocation would, of course, impact the budget. Also, the proposed requirement for $10 billion credit unions, the requirements are not affected by the proposed rule. For example, capital planning and stress testing are triggered at the $10 billion level in assets. These requirements will remain in effect regardless of the supervisory office. Right now, the proposed rule contemplates federally insured credit unions between 10 and 15 billion that have already transitioned to one supervision will remain under one supervision. Leaving these credit unions with ones rather than transitioning them back to the regions is less disruptive to both the credit unions and NCUA. Got a question here, which is, how will this change affect Tier 1 state chartered credit unions and their supervisors?
Thank you. In short, it should not. The common practice after implementing capital planning has been NCUA has taken the lead role in evaluating the capital plans submitted by the credit unions. We work hand in hand with our appropriate state supervisory authorities for each institution, and we share the results of those reviews such that they can be incorporated in our supervision plans, and importantly, when we write joint examination reports. As such, throughout the transition of this responsibility to the regions, we would encourage the same practice, that the region may take the lead in the evaluation, but they will be sharing the results with their SSA counterparts. That concludes my remarks.
Appreciate the response. Thank you. And thank you, Mr. Chairman. That concludes my remarks.
And thank you. Board Member Hood?
Thank you, Mr. Chairman. I will be enthusiastically supporting today's proposed rulemaking. Many credit unions have experienced significant balance sheet growth during the pandemic, largely due to government stimulus and a few other factors. As such, to me, it makes perfectly good sense to raise the threshold from $10 billion to $15 billion for national NCUA supervision, especially since, as we can tell from all the other questions that my fellow board members have asked, this is not going to at all take away from appropriate and proper capital planning and adequacy. And it also is not going to do anything at all to affect the safety and soundness of the credit union system. With that being said, I also believe that this provides a modicum of regulatory relief. I often mention that my fundamental regulatory philosophy is that regulation needs to be effective and not excessive. So the fact that today's proposed rulemaking is going to help up to 9 current credit unions have a modicum of regulatory relief, that's the reason I'll be supporting this. I also would just like to note from the briefing that we had, Scott, that I recognize that while we're raising that threshold, the credit unions, though, that are transitioning to 10 billion, there are other regulatory agencies that are still going to hold to that, largely the CFPB. So it doesn't mean that they will not be transitioning to them for their consumer finance protection exams. But for us, yes, that transition will be from 10 to 15 billion. I have no other comments or questions at this time other than wise move, and I look forward to hearing the comments from the field. Thank you.
Absolutely. Thank you, Board Member Hood. Vice Chairman Hoffman, is there a motion?
Yes, sir. I move that the board approve notice of proposed rulemaking, Part 700, 701, 702, 708A, 708B, 750, and 790 of NCUA's rules and regulations for a 60-day comment period as attached to the board action memorandum.
Is there a second to the motion?
Second.
There is a sufficient second. All those in favor say aye. Aye.
Aye.
All those opposed say nay. The ayes have it, and let the record show the motion passed 3-0.
Thank you for the support.
Absolutely. And Scott, I know that the staff recommendations said we should be analyzing what more we should be doing with a large credit union program. Look forward to hearing what your best thoughts are, both between E&I, the regions, as well as ones. Thank you.
Will do. Thank you.
The third and final item on our agenda today is interim final rule, part 702, prompt corrective action. Staff presenting are Kelly Lay, Director, Office of Examination and Insurance, Catherine Metzger, Policy Officer, Office of Examination and Insurance, and Marvin Shaw, Senior Staff Attorney, Office of General Counsel. Staff available for questions includes Frank Cressman, General Counsel. Kelly, Catherine, Marvin, you are now recognized.
Thank you, and good afternoon, Chairman Harper, Vice Chairman Hoffman, and Board Member Hood. This is Kelly Lay, Director of the Office of Examination and Insurance. I'm here to request the NCUA Board renew the relief granted by the interim final rule in 2020 and further extended in 2021, which temporarily modifies certain prompt corrective action regulatory requirements. This PCA interim final rule continues to be necessary to facilitate additional relief for credit unions in response to the COVID-19 pandemic. Without this renewal of the interim final rule, the rule would expire effective March 31st, 2022. I will now turn the presentation over to Risk Officer Catherine Metzger, who will discuss the details of the proposed interim final rule.
Thank you, Kelly. This is Catherine. As Kelly mentioned, we recommend adopting this interim final rule, which provides two forms of regulatory relief to credit unions to address temporary situations that may cause a credit union to fall below the well-capitalized PCA classification as a result of growth experience due to the COVID-19 pandemic. First, the interim rule enables the continuation of PCA relief related to the requirement for credit unions whose capital classification fall below adequately capitalized to meet a net worth restoration plan. Second, the interim final rule also enables the continuation of PCA relief related to the earnings retention waiver requirement for credit unions classified as adequately capitalized. As a result of the evolving COVID-19 pandemic, economic uncertainty, and the resulting increased consumer propensity to save, some credit unions continue to experience a substantial increase in shares and corresponding dilution of the net worth ratio. To provide relief to these credit unions, the interim final rule would extend to credit unions whose net worth ratio falls below 6% but is above 4%, predominantly because of share growth, the option to submit a streamlined net worth restoration plan to satisfy the requirements of Section 702.111. The streamlined net worth restoration plan would exempt from the current regulatory content requirements set forth in Section 702, such as quarterly projections and pro forma financial statements. Under the streamlined plan, a credit union would need to document that the decline in the net worth ratio is predominantly due to share growth. As with the current PCA regulatory relief, if the net worth ratio fell for another reason, such as losses, the credit union would be required to submit a net worth restoration plan as outlined in the regulation, including the content requirements. Further, if a credit union's capital classification falls below undercapitalized status, the credit union would not be eligible for the streamlined net worth restoration plan. In accordance with the Federal Credit Union Act, the NCUA's regulations, the NCUA Regional Director will consult with applicable state supervisory authority when evaluating a federally insured state chartered credit union's net worth restoration plan, including a streamlined plan authorized under this temporary rule. Similar to current practice, the regional director or state supervisory authority has the flexibility to determine that it is not appropriate to approve a net worth restoration plan, even streamlined plans submitted under this authority. In such instances, the credit union would need to submit a revised net worth restoration plan in accordance with Part 702. The current authority to submit a streamlined plan expires on March 31st, 2022, if not extended. This interim rule extends this relief until March 31st, 2023. As with the current rule, if a credit union's streamlined net worth restoration plan was approved, but its net worth subsequently declines due to losses or other reasons other than share growth, the regional director would require the credit union to submit a revised net worth restoration plan in accordance with Part 702. Extending this rule also provides the NCUA board with the flexibility to issue an administrative order specifying temporary revisions to the earning retention requirement for adequately capitalized credit unions. To the extent the NCUA board determines that the lesser amount, A, is necessary to avoid significant redemption of shares, and B, would further the purpose of this part. Upon issuance of the order, this would permit a credit union classified as adequately capitalized to retain a lesser amount to net worth without seeking prior approval from the NCUA each quarter. The regional director may still require a credit union to submit a written request to retain a lesser amount in the event the credit union poses an undue risk to the NCUA and National Credit Union Share Insurance Fund or exhibits material safety and soundness concerns. I do want to clarify that this authority granted under the prospective administrative order will only be applicable to credit unions with capital classification of adequately capitalized. Those who fall to undercapitalized or lower, meaning their net worth ratio is below 6%, would still be required to submit a written request if they are unable to retain the amount, required in the regulation, unless they are operating under an approved net worth restoration plan that provides for decreasing their earnings retention requirement. I will now turn it over to Senior Staff Attorney Marvin Shaw to discuss the NCUA's authority to make these regulatory changes.
Thank you, Catherine. As Catherine stated, under the current regulation, the board may waive the earnings retention requirement on a case-by-case basis on application by an affected federally insured credit union. In other words, the board may issue an order to waive this requirement. It does not require an application or individual orders. In response to the COVID-19 pandemic and resulting economic disruption, the regulatory change temporarily provides express regulatory authority for the board to issue a single order waiving the earnings retention requirement. Amending the regulation in this manner allows the board to respond to circumstances broadly affecting many credit unions without a single issuance, with a single issuance rather than numerous individual waiver approvals. This provision is effective upon publication in the Federal Register, and it expires on March 31st, 2023. With respect to the net worth restoration plans, the Act provides a broad directive that a credit union that is less than adequately capitalized must submit an applicable net worth restoration plan to the NCUA. By regulation, the NCUA has provided additional details to flesh out this statutory provision. For instance, Part 702 of the NCUA's regulations specifies the schedule for filing the plan and the contents of the net worth restoration plan. The rule enables the board to fulfill its statutory duty to evaluate the net worth restoration plan, even if the plan is more concise and streamlined. Such a streamlined approach is acceptable because the more extensive information provided under the current requirements may not be practicable or useful under the current situation. If a credit union temporarily falls to undercapitalized because of share growth, the net worth ratio will likely increase as the shares are withdrawn. As Catherine noted, if the regional director finds that the growth is not temporary or the net worth decline is due to losses, the regional director could require the credit union to submit a net worth restoration plan that complies with existing content requirements. This relief measure also sunsets on March 31st, 2023. That concludes our prepared remarks. We will be glad to answer any questions you may have.
Thank you so much, Marvin, as well as Catherine and Kelly, for your informative presentation today and for the great work by you and the rest of the NCUA team in bringing this interim final rule to extend temporary adjustments to our prompt corrective action rules before the board. I would also like to thank Vice Chairman Hopman and Board Member Hood for their continued support for these tailored, targeted, and temporary COVID-19 pandemic assistance measures. For nearly 2 years, the pandemic has greatly affected the credit union system and our nation's economy. We, however, likely have not yet seen the full impact of the pandemic on consumer credit union balance sheets and performance. As such, the renewal of these targeted measures for another year is a prudent course of action at this time. This interim final rule renews 2 important changes to the NCUA's prompt corrective action rules. The first change temporarily reduces the earnings retention requirement for federally insured consumer credit unions classified as adequately capitalized. While this rule is in effect, those credit unions unable to meet the earnings retention requirement will not have to submit a written application requesting approval to decrease their set-asides for earnings. The second change temporarily permits an undercapitalized credit union to submit a streamlined net worth restoration plan if it becomes undercapitalized primarily because of continued share growth. If a credit union becomes less than adequately capitalized for reasons other than share growth, it must still submit a new net worth restoration plan under the current requirements of the NCUA's regulations. With inflation, interest rate risk, and labor market and supply chain disruptions likely to continue well into 2022 and potentially beyond, consumer credit unions have much to manage. By continuing these short-term assistance measures, eligible credit unions will be able to focus on serving their members' needs, especially those of modest means and communities of color, instead of planning for earning transfers and developing detailed net worth restoration plans. With that said, I do have a few questions for staff. First, what financial or economic factors were included in your analysis to support renewing these tailored relief measures?
Thank you for the question, Chairman. This is Kelly, and I'll take that question. When considering whether to renew the interim final rule, of course, we worked with our chief economist as we evaluated several financial and economic factors. We continue to experience unprecedented times as the COVID-19 pandemic evolves. The substantial uncertainties about the continued impact of the pandemic and the current economic environment remain. For example, we're seeing an increase in inflation. Geopolitical tensions are also increasing, resulting in additional uncertainties. Other factors include the effects of various stimulus, in addition to the ever-changing COVID-19 variants that increase overall volatility as well. So these concerns continue to impact consumers by increasing their propensity to save and resulting in the dilution of net worth that we've seen in credit unions. Some of the other financial trends that we considered included the average shares per member. In March 2020, the average shares per member were $11,337, and that amount remains elevated as of September 31st, 2021, with the average share per member equaling $13,592. That concludes my response.
Thanks, Kelly. Great point on the average member shares. It's not a statistic I've looked at closely lately, but it's very illustrative of what we've seen within the system. My next question is for Catherine. Over the course of the pandemic, how has the number of well-capitalized and adequately capitalized credit unions changed over the last 2 years?
Thank you, Chairman. This is Catherine. The credit union industry has experienced material shifts in the PCA capital classification since the beginning of the pandemic. As of March 2020, 5,093 credit unions were classified as well capitalized, equaling 98% of the industry. As of September 30th, 2021, this number's declined to 4,767 credit unions, or 96% of the industry, as being classified as well capitalized. During the same period, the number of adequately capitalized credit unions increased from 53 as of March 31st, 2020, to 164 as of September 30th, 2021. This is 3 times higher than the beginning of the pandemic, but slightly less than the peak in June 2021, when 179 credit unions reported a PCA classification of adequately capitalized. This concludes my response.
Thank you, Catherine. Finally, I think this question is also for you, Catherine. how many credit unions are still reporting higher assets today than at the start of the pandemic? And how really, you sort of alluded to that earlier, but how are those credit unions performing overall?
Thank you, Chairman. The credit union industry has experienced systemic growth since the beginning of the pandemic, with 4,761 credit unions reporting higher assets as of September 30th, 2021, compared to March 31st, 2020. Further analysis of these credit unions illustrate over 4,000 credit unions reported a positive return on average assets as of September 30th, 2021. This equates to over 85% of the industry experiencing growth while still remaining profitable. This concludes my response.
Great insights, Catherine, and thank you again to everyone overall. These answers illustrate the need for continuing this targeted and temporary pandemic assistance measure, and I will support this interim final rule. That concludes my remarks. I now recognize Vice Chairman Hopman.
Thank you, Mr. Chairman. I want to start by saying, thanks to Kelly, Catherine, Marvin for the presentation. 2 years ago, I think few would have predicted we'd now be going into year 3 of the pandemic. That said, I'd like to make clear that this should be the last time we renew this policy. Barring something very unexpected, this policy should expire in March 2023. Temporary policies that keep getting renewed aren't temporary. I'm reminded of the rent control policies that still exist in New York City, first enacted as an emergency measure in World War II. The 2 temporary changes to prompt corrective action regulations mirror what was done in 2020 and 2021. One amends the regulations to waive their earnings retention requirement for any federally insured credit union that is classified as adequately capitalized. The second modifies the documentation required for net worth restoration plans. The changes address pandemic-related factors affecting both the Share Insurance Fund and the net worth of many credit unions. Share growth remains unusually high compared to pre-pandemic levels. Specifically, share growth in the year ending September 30 of last year exceeded 14%. The impact to net worth is not generally due to risky lending or investments. In fact, if NCUA did not provide net worth flexibility, it would have resulted in greater statutory pressure to increase yields on loans and investments, to increase retained earnings and meet regulatory requirements. Pressure to reverse net worth ratio trends by reaching for yield during this unprecedented period could be counterproductive. Streamlining the net worth restoration plan process benefits both affected credit unions and the UNCUA by reducing paperwork. It does not mean that the plans aren't reviewed closely. The regional directors have the authority and discretion to work with credit unions if needed. Unfortunately, life is still not business as usual, and I urge credit unions to work with the regions if they feel the need. In general, I support keeping these kinds of decisions at the region level, where staff are closer to the day-to-day challenges faced by credit unions. One question here to start: how many credit unions are affected by this PCA relief, and what percentage have had positive earnings? And is there a way you can wrap this in? Does it tell us something about the prospects that this should be the last time we renew the policy?
Thank you for the question. This is Kelly, and I will take it. So the PCA regulatory relief, initially issued in 2020 and reissued again in 2021, and accompanied by the administrative order, reduced the earnings retention requirement to 0 for credit unions with the PCA classification of adequately classified. And over the period, the number of credit unions classified as adequately capitalized varied between 77 credit unions to as many as 179 credit unions receiving the relief. So in analyzing the industry as a whole from March 31st, 2020, when the COVID-19 pandemic began, to September 30th, 2021, as Catherine mentioned earlier, we have over 4,500 credit unions experiencing growth, or 95% of the industry. Of those, 153 credit unions experienced a decline in the PCA classification from well-capitalized to less than well-capitalized. And of those 153 credit unions, 2/3 reported a positive ROA as of September 30th, 2021. So that really illustrates that the majority of credit unions experienced a dilution in net worth due to share growth and not negative earnings, and also demonstrates the temporary need for relief. I would say there's still uncertainty around the pandemic, and operations continue to be significantly disrupted, due to things like social distancing practices, remote work, supply chain disruption, and other related complications. Also, the unprecedented amount of fiscal stimulus and decreased spending opportunities have led to a significant increase in the personal savings rate over the last 2 years. So it's hard to predict what next year will look like. I think we need to do further analysis and consider if the increase in shares are just going to stick around and whether credit unions need to plan accordingly. That concludes my response.
Thank you, Kelly. So are credit unions still required to submit a request for an earnings retention requirement waiver?
Thank you. This is Catherine. I can answer that. Under the current interim final rule and with the issuance of an administrative order by the board, only credit unions with a PCA classification of undercapitalized or below who are unable to meet the earnings retention requirement outlined by the regulation or established by their approved net worth restoration plan would be required to request a waiver of the earnings retention requirement. Therefore, the earnings retention requirement is still in place for those credit unions with a greater net worth deficiency. That concludes my response.
Thank you, Catherine. And last one, during the pandemic, how many credit unions were allowed to file streamlined net worth restoration plans due to share growth only? How many requested, how many were denied?
This is Catherine, and I'll answer this as well. The agency received 14 requests for the approval of streamlined net worth restoration plans. Of those, we were able to approve 9 of those requests. The remaining 5 requests were denied, and those credit unions were required to submit a full net worth restoration plan meeting the requirements of Part 702. As it was determined, their net worth capital classification decline was due to other supervisory concerns and not predominantly due to share growth. Thank you. I hope that answers your question.
Yeah, it sure does. And I think it makes the point also that it makes sense to wind this down in a year. But when this ends, 3 years, there may at that point be quite a few number of credit union CEOs that started after March 2020 and have never lived in a universe where this wasn't allowed. So temporary should mean temporary. But appreciate the well thought out answers. And thank you, Mr. Chairman. That concludes my remarks.
I agree with you fully on your thoughts about temporary. At some point, we do need to wind this down. Board Member Hood, you are now recognized.
Great. Thank you, Mr. Chairman. And I want to thank Kelly and Catherine and Marvin for today's presentation. And it's great to see all of you. It really is. Because of recent government stimulus, in addition to our other factors surrounding the pandemic, I support extending this provision in the event that credit unions temporarily fall below the well-capitalized level and become subject to various prompt corrective action requirements. This rule provides regulatory relief to those that experienced a decline in their net worth ratios due to current events. And Kelly, I want to applaud you because you really clearly enunciated what some of those current events are, and especially bringing in some of the geopolitical activities that we're now seeing. The interim final rule before us today allows the agency to address problems in credit unions that pose elevated risk to the National Credit Union Share Insurance Fund. I, again, will be supporting it. Mr. Chairman, I must so say, rhetorically, I have to wonder if this is going to become permanent, since this is, in fact, our 3rd time voting on this matter. But again, just rhetorically asking it. And I have no further questions or comments. Thank you.
A very good point. With that, Board Member Hood, I understand you have a motion.
Yes, Mr. Chairman, I move that the board approve interim final rule part 702 of NCUA's rules and regulations as attached to the board action memorandum.
And is there a second to the motion? Why don't we give the vice chairman a second to get back to his seat? In the interest of time, I will second the motion, but we should wait for him to come back so that he can vote on it. Great, welcome back. There is a sufficient second. All those in favor say aye.
Aye.
You're on mute. Not Board Member Hood, the Vice Chairman.
I shouldn't be on mute, right?
Yeah, you're off mute now.
Okay, so you need me to second the motion?
Well, no, we
Okay,
seconded the motion. We're voting now. All those in
We did
favor say
that. Aye.
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 Okay, here we go. The ayes have it. Are there any nays? There are no nays. The ayes have it, and let the record show that the motion passed 3-0. Thank you, everyone. This is the end of our agenda today. There being no further business, we are hereby adjourned.